Welcome to the deep dive video update. This is a weekly video where I go through and look at all the charts that I use throughout the week, and maybe those that I didn't use all that much, I put in this video. And there are also some other charts that I use just in this particular video. This is being prepared for Monday, May 8th. The first chart is only for this video, and it's a long-term range of the VIX. Now, we've been going down. 2025 has not been a good year for the market. We'll see if it gets any better. But as stocks have been going down, the VIX has been going up, but we're still not above this 20 level with the longer range. Now, if we run into some trouble and start going down again, the expectation would be that we would go above this red line. If we can keep going up and the VIX can continue to drop, then we would stay down below this. This is really just for information because when we're in more negative climates, we have a higher VIX. When we're in more positive environments, we have a lower VIX. Also, I do some studies on the VIX itself, a lot of different ones. This one comes and goes out of the daily video. This just measures how fast is the VIX going, and I use an RSI based on 9 periods to do that. We look for extreme positive or negative readings. Not getting one of those right now, so I haven't been showing this chart. Also, another study involving the VIX is a correlation of the VIX with the S&P 500. When we pay attention to this chart is when we go above the dashed line. We're still getting kind of a low reading here, so there's been no need to show this chart. Also, we look at the VIX, and then there's this other thing attached to the VIX called the VIX of the VIX, or the volatility of the VIX. And I do a ratio between the two here. And as a general rule, when this is coming down, that tends to be more positive. This has been going back up. That means the VIX is going up more than the volatility of the VIX. And that's usually more negative. We chopped around sideways, not really doing much in 2023, 2024. And then we've really been starting to go up now in 2025. And this just kind of confirms the more negative environment that we've been in. Also, a variation of the VIX is called the SKEW Index. It's calculated in a different way. When I pay attention to this chart is when this reading gets up into the red area, and we're not there now. Also, this just came out of the daily videos. This is similar to the VIX, but it was designed a long time ago to be used with mutual funds. People that didn't really, well, I don't even know if the VIX really existed before this indicator did, but this is just a way of measuring, are we really going down? And it's appropriately called the Ulcer Index. And I only show it in the daily videos when we're above the moving average. We've been coming down as stocks have been going back up, so now we're underneath the red line. Then Landry Volatility. I'm not sure if this is all that useful either. We kind of just have a flat line going on here, and then when stocks started really moving around, we went up, but we're not really seeing much gyration with this overall indicator. It's supposed to be another volatility measure. Then we look at the volatility of stocks, that's the VIX, and the volatility of bonds, that's the MOVE index, and then do a ratio between the two. And generally, when this red line's going up, the market can also be going up, but lately it's really been going up as we've seen a big increase in volatility. But now, since the S&P's been going up, we're actually seeing this coming back down. And this just means that volatility of stocks to bonds is decreasing, and the moving average is starting to pick that up as things appear to be a little bit more under control. But that can change to being out of control at any time. Then this comes and goes out of the daily video too. A ratio between the large caps is measured by the Russell 1000. That would be kind of like the S&P 500. And then the more popular index called the Russell 2000, that's for small caps. And just do a ratio between them, large caps and small caps. When this is going up, that means large caps are outperforming. And they have, even though we were going down, large caps were holding up. The small caps are still the weakest part of the market right now, based on what I look at. And that's why this ratio has been going up. It doesn't mean that large caps are going up. It just means that small caps are doing even worse. Then, just for informational purposes, where are we? We set a low back in October of 2022. Then, as of Friday's close, we're up 62.73% from that low. Then we set another pretty significant low in October 2023, and that shows that we're up 38.57% from that low. I update this every Friday. Then stockcharts.com comes out with technical alerts. I go through them typically every day in the daily videos, but this shows all of the alerts for the week. And you can create your own alerts. I just use the generic ones because they apply to the S&P and different sectors and different indexes. And we start at the bottom with this particular chart. That's Monday, and then the very top is Friday. And we can see when we're having a more positive day, we see green. When we're having a negative day, as we were on April 30th, that's when GDP came out, and we saw a lot of red at that point. Well, we've been bouncing back up since that time, and it's been more positive than negative. Then there are six indexes that I follow: the S&P, the Dow, the Nasdaq Composite, the Nasdaq 100, mid caps and small caps. And then on a score of 0 to 100, which index is looking the best right now? Coming in first place are the Qs. We're seeing a little bit of life over here. Still not a great score, but much improved from where it was. We were down into the 20s here for a while. Now we're coming in first place this week with a score of 67.3. In second place, which is both growth and value, is the S&P. Not a great score, but improving, coming in at 51.5. Then we have the Nasdaq Composite. That's in third place at 48.8. Then the Dow, which had been holding up better as we were going down because they're considered to be the best of the best stocks. And so when we are under pressure, the Dow will often hold up better, go down less than some of the other indexes. But it's coming in with a score of 30.5. Not great, but improving. And we have the mid caps, which have been really not doing all that well. We're still below 20 with the overall reading, coming in at 19.9. And here are the small caps, the IWM ETF. And we're finally out of the single digits. We're coming up into the 10.9 range, where we've been below 10 now for quite some time. Then a short-term rainbow chart going from 10 periods up to 50 periods with a simple moving average. I changed the color here, and you can kind of get some insight by looking at this, but I pretty much only show this chart in this video unless it's really telling us something. But in the short term, when price is above all the lines and the lines are going up and they're nice and smooth, that just shows we're in a solid uptrend. And then when we're going down, like we have been, price drops below the lines and the lines start to come down. Well, we're trying to get back above the rainbow right now. And so far we're there, but we need to stay above this and then have the lines be able to turn and go back up. Now, if we fall back down into the rainbow, because we might see a pullback, then the lines will just continue to go down. Then here's another rainbow, but this looks at the intermediate term, going from 50 to 100 periods with simple moving averages. This is also in a downtrend. We've been negative. We finally recaptured the 50-day moving average this past week, and so the intermediate term trend has turned back to positive. But this is a series of moving averages just to show us what is the overall flow. It had been positive. We had our pullbacks in 2024, but they were quick, not lasting long enough to really change the rainbow all that much. Well, what we're seeing now has been more severe. We're actually seeing the rainbow coming down, but price is trying to get back up into the rainbow. And if we keep going up, we'll be able to get above the rainbow. Then Bollinger Bands, and there's a big, thick book written by John Bollinger that talks about the different ways you can implement Bollinger Bands. This is just one implementation. It's called the percent B indicator. When we close either above or below the upper or lower Bollinger Band, that's what's measured down here. We can take another little look at this and get more of a positive reading because we're crossing back above the midpoint. The dashed line that you see here, that is the midpoint. And when price crosses above that, it tends to be more positive. So we are looking better, but not extreme right now. Then these are some newer charts that I've been using. This is called the proper order. And we see how long a trend is lasting. That's the number of bars that are drawn in. The longer it lasts, the longer this ramp gets built. Well, even though we've been bouncing back up, according to this chart, we're red in the background. When we're positive, we're green. So this is still measuring that we're in a downtrend. Now, there's other charts that we're looking at that are showing that we're actually in an uptrend, but I haven't included this chart in the daily videos, so I wanted to put that one here. Then this is one that comes and goes depending on whether we're dealing with important levels or not. This is just a percentage measurement of different moves that we've seen in the market. And you can't see it way over on the left, but that's the October 2023 low, showing that we're up over 27, almost 28% from that low. But when I was really using this chart is when we hit the all-time high in February, and then we started our decline. And then on an intraday basis, we actually went into bear market territory. We were down over 21%. But the way the market does it, they do it on a closing basis. And so we were able to come back up out of that. So the S&P on an intraday basis went into bear market territory, but on a closing basis, it did not. And now it's starting to come back up, and we are showing some improvement here. And we'll, again, not really getting additional insight other than just showing what's already happened. Then this comes and goes too, because we're finally back in pullback territory now. When we declined more than 10%, that's a correction, and that makes this chart go up. This dashed line is the 10% level. Well, we've been going back up now, and currently we're 5.43% below the all-time high. Still kind of significant, but the market has made a remarkable comeback as of late. Then we look at the S&P 500 and the S&P 100, not really seeing any real divergences here. They're pretty much converging with each other. Then another long-term rainbow going from 50 periods up to 250 periods. And this has been lasting a while. So we're seeing the shorter term moving averages starting to come down, but the longer term moving averages are still holding up. And we're back above the 250-day moving average, but that's not really what I use. It's the 200-day moving average that I use and that what most people use. So that's still above current price. And so that may act as overhead resistance. But as we've been improving, we're trying to come back up into the rainbow again and see if things can turn more positive. This is something I mention in every daily video, but I only show the chart here. This is the daily chart of the special K, just like the serial. We don't get very many signals with this chart, so that's why I just reserve it for this particular video. And we did cross down below here in March, and that actually turned this negative, a very long-term momentum oscillator. Well, as we've been coming back up, this is turning up and improving, but we have quite a ways to go just to get back up to the red line. Incidentally, I do cover the weekly chart in the weekly video, and we're just about getting ready to cross over negative there, where we had been positive. Then we look at a weekly chart of the S&P on top and the German DAX weekly chart here, and we're seeing Europe bouncing back up here. What was happening in March and into April, the S&P was coming down as the German index was going up, and that was creating quite a difference in the correlation. It still has a ways to work out here, and we're getting a neutral reading right now, but you can see by looking at the chart that German stocks are actually doing a bit better, at least in 2025, than what we're seeing in the US. Then some support and resistance. I was using this chart. This is a mini rainbow. It's just a simple moving average of the open, high, low, and close. And sometimes when we're below it and we try to break back above it, one of these lines may act as resistance. And then we came back down, and sometimes these lines may act as support. Well, we're above the rainbow now, and the rainbow's starting to turn back up. So that's more positive. But since we're far away from the rainbow now, there's been no need to show this chart. Ichimoku cloud, the reason I haven't been showing this is we still have a ways to go just to get up to a red cloud. Now we are improving with the trend studies here. The green line, that's short term, that's going up. And then we have the blue line above the red line. That's positive too. So it's like short, intermediate, and long term. So things are improving on this chart, but we're also seeing that with other charts that we have. When I'll be showing this again is if we do keep going up here and we start to work our way into the cloud. Then some broad market measures. This is the VIXen, which is like the VIX, but this applies to the NASDAQ 100. I don't use this one all that much, and mainly because this chart looks like icicles falling off a roof here. This is the closing value down here, and as the NASDAQ 100 has been going up, the VIXen has been coming down. Then we look at the S&P on top, and then this is supposed to be a ratio between growth versus value. And then at the bottom is the correlation between the two. Or the Qs, that's growth, that's the NASDAQ 100. The Dow, that's supposed to be value, even though there are growth stocks in the Dow. But we see that the correlation is pretty strong. We're not really seeing anything all out of line right now. Then I look at the Dow and the transports, the red line of the transports. They're trying to bounce back up here, but they've really been underperforming and not doing all that well, either in 2024 or now into 2025. We want to keep an eye on the whole financial sector. This is just one part of it, which are the banks and the bank ETF. This is in a downtrend. We saw a death cross here, but we've been bouncing back up like everything else, and we're back above the 50-day moving average, but we're still below the 200-day moving average. And then we look at a ratio because we want to keep an eye on those smaller banks, the regional banks. And we do a ratio of the regional banks to the financial sector. And this is in a downtrend. It's not really falling apart, but it's trying to improve a little bit here, but it is in a downtrend. Where you really see this drop off, this is when Silicon Valley Bank and Republic Bank, that's when they were having their problems. Then we stabilized here at a lower level, and then we dipped down when New York Community Bank was having their problems. So we just want to keep an eye on this because I went through the great financial crisis and there were some warning signs, and we just look at the charts to see if they're telling us that maybe there's trouble on the horizon. Then some rate of change charts. I just use these for information. They're long-term, 250 periods. We came down and actually dropped below zero, and now we're starting to come back up. This is showing the long-term trend is improving. This is also 250 periods, but it goes back further. We came down below the zero line, and we are improving again. Then this, I use these a lot in the what to watch video because this is just something that we're keeping an eye on. We want to look at the relationship of bonds to each other because sometimes we can get some clues as to, okay, is the bond market worried about interest rates going up? Is it worried about inflation? So we look at some ratios, and this is cash to 3 to 7 year bonds. Now this is going down, which if the market was more concerned, this ratio would be going up. So this is telling us in a short term, because this is 1 to 3 months to 3 to 7 years, the bond market's not really worried about inflation or interest rates. And that's pretty much the conclusion that we've been reaching lately. We do that same analysis here, but we use tips which do adjust for inflation and interest rates. And when interest rates are going up, people like to get in tips. When interest rates are coming down, they stop getting into tips. They get into treasury bonds like the 3 to 7 year bond because they think that interest rates have topped out. They've locked in a higher rate and then rates are going to come down. Well, this ratio is not really showing any concern here. We were a little bit nervous back in 2024 when this ratio was continually going up, but then it came back down. You would think if the bond market was concerned, this ratio should be going up when it continues to go down. Then that same basic thing here with tips, but then we look at further out bonds, 7 to 10 year. Not really seeing any concern. Still in an uptrend, but this uptrend is weakening. And this suggests even in the longer term that the bond market's not really worried about inflation or interest rates. Then we look at the long-term bond, which is in blue, and then the S&P, which is in red, and we see that the long-term correlation is fairly strong, and even the short-term correlation based on 10 periods is pretty strong. We just want to keep an eye on this to see if they're getting really out of line with each other. Not really seeing anything strange here. We do that same thing with looking at the long-term bond. Here it's in red versus the QQQs, which is the NASDAQ 100. And this correlation is actually starting to get stronger. It's just barely coming out of neutral territory right now. And we look at the 10-year yield in the US and we subtract the German 10-year yield. And since US rates are higher, we get a positive result. And then believe it or not, we plot the US dollar index down here and we can do a correlation between the top chart and the middle chart. And this is pretty strong. And this is consistently what we've seen. What we're looking for is something really weird to happen where we go down into this red area. When we're more in this blue area, it just means that it's a stronger correlation and that things are okay. They may not be going the way we want them to, but we're not seeing anything really out of line. Then we want to keep an eye on the 2-year Treasury yield, which overall has been declining in the shorter term. We watch that because of inverted yield curves. We look at the 10-year to the 2-year yield curve, and that's back to being normal now as the 2-year yield has been coming down. Then here is the 10 to the 2-year yield curve where you can see it's actually steepening here a little bit. We're no longer inverted, but what we're watching is the 10-year to the 3-month. It's back to break even after Friday. They're both giving the same yield currently, but we were inverted for quite a while. Then we started to be normal, and that usually starts a countdown to see if we're going to go into a recession. Then we went inverted again, and we've been inverted for the most part. We just came back to zero on Friday. We'll see. Are we going to come out of here? Does that start a countdown? Which, when I say countdown, that just means we're looking at the charts more because I can say 3 months, 6 months. It's not like, 94 days we're going to go into a recession. We just kind of have to watch things a little closer. And just to compare apples to oranges here, the Eurozone stocks in Europe compared to 3 to 7 year bonds, showing that the Eurozone is outperforming. Even though the bond market's been improving and stabilizing after it was going crazy there for a while, we're seeing that European stocks are actually stronger. Then these are things that come and go, but I haven't really used them lately. These are the percent of stocks in the S&P above their 200-day simple moving average. I have another study that I do show pretty much in every daily video. This is that same thing, but just set up in a different way, where this is developed to be like an oscillator, where we look for extreme positive or negative readings, not getting any right now, and we're just a little bit below 50. Now, if we go above 50, that's going to turn this more positive. And the other chart that I have that's similar to this, that will look more positive too. So we are showing some improvements here, but it's not positive yet. And we use that same basic idea with stocks above their 50-day moving average in the S&P. We had come down and we were extreme negative, and now we're starting to bounce up out of that, and we're actually crossing above 50. So this is turning positive. Just to get a better perspective, we look at the mid caps, and this is improving, and it's a little bit above 50 as the mid caps have been bouncing, and we're still below 50. We're at 47 now with the small caps, but they've also been improving after being extreme negative. So thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.